Hello, I'm Peter Switzer. Welcome to the program that helps you make the absolute most of your money. On Switzer Tonight, we'll see what moved the markets today. Plus, Roger Montgomery tells us how to value the best listed companies and buy them for less than what they're selling for, rather than what they're worth. We're now going to talk to independent investment expert Roger Montgomery about his strategy for value investing. That's how to value the best companies and buy them for less than what they're worth or what they're being sold for. Let's ask that question when we get to him. Roger joins me in the studio. So is it what they're worth or what they're selling for?
It's what they're worth. I don't take my cues from share prices, and I don't think anyone else should. Turn the stock market off. And that's, you don't want to hear that on this program, but turn the stock market off, don't look at it, and think about businesses. Think about, and all your guests run businesses, you know. Kathy Harris has been on the show. She runs a business, Harris Farm, and
Jeff Wilson.
Jeff Wilson. I mean, what are the businesses worth? What are the real businesses worth? Whether even if they were not listed on the stock market, then you turn the stock market back on and have a look at whether or not the share price is lower than their true value. I
hate to correct you, Roger, because you hate being corrected. I know that too.
I don't mind.
No.
Always happy to learn.
But the thing is this. Once you use your wonderful method of valuing a company, then you do have to watch the market to see whether the price is ridiculous, because if it's really low and you've valued it up here...
That's what these things are for.
That's right.
They tell you.
Yeah, so you I'm trying to make sure people keep watching the program, because by telling them what's going on, then we can pick it out.
I don't know. Okay. Look, there's a lot to learn. It's not easy. And so what we're going to do today, we're going to talk about step number one. And what we're going to do is we're going to estimate the cash flow of a business using nothing more than the balance sheet. So what we're going to do is we're going to find out...
I always reckon it's a big call. But let's just do it.
Not hard to do.
Okay, but this is your favourite company, or one of your favourite
Well, it's one of them. Yeah, it's one of them. I've had a long relationship with this company. It floated, and in 2004, I just launched my listed investment company. I don't run it anymore. I've sold that. And this was one of the first investments that I made. I became the biggest shareholder in the Reject Shop. Bought it at $2.40. It's now $16, $17.
Yeah.
It's been a great business.
When you're tipping it maybe around the 5s or 6s, and I thought, what a reject business to support. But when you looked at the numbers, they were there. So let's go and have a look.
Let's talk about the numbers.
Okay.
Okay, so one of the first things that we need, and it's obvious that this has been split up into a few parts, but when you think about a business, if you owned a business and you're running a business for a year, then what we would notice is that at the end of that year, we want to know whether or not there's more cash in the bank than we started with. Okay, now I'll give you some theory first, and while we're looking at this. So you can see here that the cash has actually gone down from $5.3 million to $865,000. Okay, so that means cash, if you like, there's been a cash loss in this company. But there's a bit more to explain, and that's where I'm going to go.
Okay, good.
Let's suppose that we start off with cash going up, a business where cash has gone up. Now, how could that have gone up? What are the different ways that could have happened?
They would have sold more stock, they might have bought a product at lower cost, and there was more cash. Okay.
Yep. And how else?
Well, it could have been...
Could have borrowed money from the bank.
Yeah, good point.
I could have borrowed money from the bank and put that in my bank account, and that could have made the cash go up.
Made it look a lot better.
It makes it look better, but it isn't better. So we've got to reverse out. We've got to reverse out the change in the cash. I could have also tipped in some of my own capital.
Equity.
To put equity into the business as well.
Make the balance sheet look...
I've got to back that out. But I also might have paid myself a big dividend during the year, and I've got to add that back in because that would have reduced the cash. Now, if I do those four things, I'll work out what the real cash profit of the business is. So anyone watching your program who runs a business, they would know that their accountants every year hand them a tax return, and they say, congratulations, Peter, you've made $4 million this year, and you turn your pockets inside out and you go, well, where's that $4 million? And I've got a tax bill. You know, and so the cash flow of a business is very different to the profits that the accountants report.
I always remember when I first started doing business reporting, and one bloke said to me, you can go a long time without net profit, but you can't go very long with a negative cash flow.
That's exactly right. And I've got a friend of mine who runs a very well-known restaurant in Sydney, and he says to me, Roger, revenue is vanity, profit is sanity. and I like that. Okay, let's look at this table. So what's actually happened here is the cash has gone down from $5.3 million or $5.4 million
in 2008.
exactly down by $800,000. So really there's been down to $800,000 or thereabouts. So it's, if you like, it's a decline of $4.6 million.
Yep.
Now, what we need to do is see the next screen, and hopefully the next screen's there. Okay, so we've got our fixed assets. We'll go to the next screen where we've got our liabilities. All right, so now we've got our borrowings. Our borrowings have gone up.
Yeah.
Now, notice the borrowings have gone up by about, what's that, 1.5? 1.6?
Yeah.
1.6. So on top of the 4.6 loss in the cash, we've got to add on 1.6 because the debt has gone up as well. So they've added to their cash balance by borrowing money, if you like. So at the moment, we're down $6.2 million. If we go to the next screen, we should have the equity coming up next. Provisions, no, keep going. Total net assets, all right, and one more. We should have one more. There we go. Okay, so look at contributed equity. The shares, the contributed equity has gone down from $4.2 million to $3.4 million or thereabouts. Yeah. So it's actually gone down. What's that? 600, 800. So off the 6.2 million, I'm going to take off 800,000. Because that's been contributed. They've bought back shares. That's contributed. That's gone in. And we'd need to know the dividends. Now, the dividends, let's say the dividends were about $10 million. I haven't looked for the total on this particular sheet. But say it was $10 million that they paid out in dividends, and you'd get that from the notes to the accounts. So I'd add back $10 million, and we end up with, we end up with about $4.6 million of positive cash flow from this business. Now, that is explained by all the other changes of all the other items on the balance sheet. So we can get rid of that and the camera can come back to us if it likes now. We're not going to use that.
The camera would have missed us,
Yeah, exactly. So we've had a long chat and people are probably sick of looking at the screen.